So, the past few weeks have been crazy. From recent announcements that there are potential treatments to the illness, to US unemployment claims recently rising to just under 800,000. But at the same time, US consumer spending has grown for the 6th straight month. And all of this is happening at the same time as the Dow Jones reached a record high of 30,000, and the world stock market index has just hit all-time highs. So I don't know about you, but all of this, it seems pretty confusing to me. I mean, we all kind of know what's happening on the high street and with businesses, but when it comes to the stock market, it simply doesn't seem to be reflecting reality anymore. So in this video, I'm going to be breaking down for you all of my research about what has been happening. I'm going to explain why the world stock markets are not crashing with everything that's been going on, and most importantly, what could be coming next? Are they headed higher, or is a crash due? Hey, and welcome back to the channel. I'm Tom. Every Tuesday and Friday, I share videos with you on investing and finance. So if you're a bit of a nerd like me and you like those kind of things, make sure to subscribe so you don't miss the next update. Right, so let's kick it off with a quick recap. In the past few weeks, we've heard that there are 3 potential treatments to the illness. Now, none of them have a 100% success rate, and we don't understand the long-term side effects yet. However, on the back of this news, the stock market looks like it's predicting that life might finally be returning to some type of normal during 2021. So while global economies, they're still struggling, stock markets are actually performing much better. The reason is, the stock markets are forward-looking. So basically, people invest based on what they think is going to happen, not what is currently happening today. So for example, if people believe that the economy will recover strongly in 2021, then they are likely to buy businesses which will benefit today, and that drives up the stock prices ahead of time. But the other reason as well that the stock market is doing so well, and I think is actually more impactful, is because of central banks. So in the US, for example, you have the Fed, or the Federal Reserve, and among their responsibilities are to raise or lower interest rates, and they have the ability to create new money and use it to boost the economy. As of today, the Federal Reserve has maintained its target for the federal funds rate at a range of 0% to 0.25%. So to keep it simple, this interest rate which the Fed sets indirectly impacts the interest rates that you might be paying, or the businesses might be paying. And when money is cheap to borrow, it encourages people to borrow more, which usually results, if they use it correctly, in economic growth. It also pushes up the value of things like real estate as mortgages become cheaper. Now, in terms of printing money, as of today, the Fed has printed a total of $7.2 trillion, and they've used that money as another attempt to kickstart the economy. As we can see from this chart on the screen now, when it comes to creating new money, the Fed has taken a huge step. So between the years of 2008 and 2013, during the previous financial crisis and the years after, they only printed $2 trillion. In 2020 alone, they've printed a further $3 trillion. So in 5 years, they printed $2 trillion, and in just this year already, they've printed $3 trillion. Some of this money has been put to good uses. For example, allowing the government to have the necessary money to pass important stimulus packages. Some of this money has been going to less needed uses, such as Apple, who definitely don't need more money, being able to effectively borrow money from the Fed at a very low cost. Okay, so now that we're all caught up and we've got an overview of what's been going on, let's have a look at what's happening today. While recent data shows economic growth slowing and consumer confidence flagging, markets are forward-looking and betting the recovery will gain steam. Investors are looking to mid to late 2021, when conditions should return to normal and we're not going to have too much long-term disruption to the economy, according to Gus Foucher, the chief economist at PNC. Some forecasters are even more optimistic, expecting economic activity to surge with the release of pent-up demand. Households have paid down debt, and the personal savings rate was a high at 14.3% in September, compared with 8.3% before the pandemic. Joseph Brasulis, the chief economist at RSM US, notes that this is one of those times where the disconnect between markets and the economy, it makes sense. Other factors behind the market gains include size. Public companies tend to be large. Unlike small and privately held businesses, the big public companies in the major stock indexes can more easily access capital and have robust balance sheets to get them through periods of turmoil. Larger companies, generally speaking, are also more able to adapt quickly and introduce changes to their business, such as focusing on the digital side of their company. Sadly, smaller and family-owned businesses, unfortunately, they often just don't have access to the money or the ability to make the kind of necessary changes to their business, especially with the rules seemingly changing just about every single day. But what about the economy moving forwards? Well, IHS Markit, an economic analysis firm, projects US gross domestic product will expand at a 3.9% annual rate in the current fourth quarter, down from a record 33.1% pace in the third quarter when many businesses reopened. Investors are encouraged by continued government stimulus and the possibility of more. The Federal Reserve has indicated it won't be raising interest rates from near zero anytime in the near future. It has been buying $80 billion in treasuries a month and $40 billion in mortgage bonds, net of redemptions, since June, after buying even larger quantities beginning in March to curb market dysfunction. However, some economists are circumspect about the financial market's enthusiasm, saying that investors are not factoring in the potential for more strong measures just like those recently seen imposed across Europe. If bars, restaurants and gyms have to shut down again, the unemployment rate is likely to rise after gradually dropping to 6.9% in October from nearly 15% in the spring. James Knight, an economist at ING Financial, said the market's growth is very rose-tinted as the macroeconomic backdrop could deteriorate in the new year once a nationwide eviction moratorium, a suspension of student debt payments, and tax breaks for businesses, they all lapse. Several unemployment aid measures passed in the spring have already expired or are set to expire at the end of this year. So with this video, my goal is just to explain to you what's going on. And I want to show you both sides of the argument, both the positives and the negatives, because I think it's really only right to give you both perspectives and not just focus on only one. Now, I am going to share my own opinion as well, and you may disagree, but that's absolutely fine. It is just my personal opinion, so I'll explain how I kind of see it. So I heard a metaphor of the economy which really resonated with me, and I want to share it with you. The economy is kind of like a train. It's extremely heavy and it takes a lot of effort to get it moving once it's come to a stop. So the Fed, they can lower interest rates and they can print obscene amounts of money, which is like fueling the engine. But it takes a lot to get the economy going again. Now, in 2020, we have had a completely unique situation. I mean, out of nowhere, the economy was forced to just come to a dead stop. And once things began to reopen, it was always likely that certain businesses were going to bounce back really quickly. And that's why you've probably seen almost unbelievably positive headlines about things like record employment gains or record economic growth in the space of just a few months. But the real question, for me at least, is how long is it going to take for the rest of the economy to bounce back? Not just the jobs which are always going to return quickly, but the ones that are still at danger even now. Also, what's going to happen when things which have been kicked down the road come due? So as this last article noted, a nationwide eviction moratorium, a suspension of student debt payments, and tax breaks for businesses will soon lapse. At the beginning of this year, I thought that the economic forecasts that people were putting out, I thought they looked just a bit too good to be true. And to tell you the truth, I still think that many of them look the same way, a bit too good to be true. However, at the same time, I don't actually know how much this is going to affect the stock market. Which sounds kind of crazy, I know, but just hear me out for a second. So we already know that most businesses are making far less money than they used to. We also know that the stock market is up this year. Part of this can be explained by the fact that the largest companies today, they just take up such a huge proportion of the market and they're doing quite well. But another factor is simply that businesses are worth more today for every $1 that they make. So this chart on the screen now is known as the Shiller PE ratio. And without getting too technical, it basically gives us a comparison of the value of the companies in the stock market compared to how much money they actually make. The mean value since this chart began rounds up to 17. So let's draw that line on the chart. The median value rounds up to 16, so pretty much the same line. So anything below this line basically means that the companies in the stock market, they are cheap compared to how much money they make based on historic averages. And anything above this line means that the companies are relatively expensive compared to how much money that they're making. As we can see, the value today currently sits at 33.2. That is nearly double the historic average and the median value. In other words, companies today are valued twice as much for every $1 that they earn compared to historic averages. Or said another way, if we took the earnings of companies today and applied a historically average ratio, the stock market would drop by 50%. Now there are some other factors at play, but it's just kind of crazy when we actually think about it like this. So the question then is, why are companies valued so highly when they aren't actually making much money? Firstly, like I said at the beginning, investors are investing based on future earnings, not today's earnings. That means companies are priced based on what people expect them to earn in the future, not what they're earning today. Whereas this chart is just showing us today's earnings. However, many investors will tell you another reason, which is far more significant than this: the Fed. The Fed they've acted so quickly and so dramatically that the stock market, it basically hasn't been allowed to crash. You might have heard the term, don't fight the Fed. Well, this is usually in reference to the fact that the Fed are supporting companies in the stock market, so betting on a stock market crash is essentially fighting the Fed. So if the Fed have such a huge impact, it's really, really important to follow what they are doing because they have a huge impact on what's going to happen next. So let's take a look. In September, the Fed provided guidance about interest rate plans by laying out 3 economic conditions that would need to be met before it raised rates from near zero. The Fed said that it would hold rates at that level until the labour market is healed, inflation hits 2%, and inflation is projected to run moderately above 2%. Similar guidance for the asset purchases could say, for example, that the central bank won't reduce the pace until life has returned to normal or until the officials are satisfied that they are on track to meet these other conditions. Fed officials are navigating an outlook clouded by the risk that the economic recovery slows in the winter months amid rising cases. At the same time, positive developments about treatments raise the prospect of a stronger rebound in 2021. Now this bit is really interesting. In their economic briefing prepared for the meeting, Fed staff removed from their outlook the assumption of additional spending from Congress and the White House given the lack of progress in reaching a new agreement. Although this lack of new spending would cause significant hardships for a number of households, the economists judged that the saving cushions accumulated by other households this year would be enough to maintain overall spending over the next few months. So we have quite mixed messages here really. From the sound of it, the Fed are willing to do just about whatever it takes until things have returned to normal. But at the same time, they're acknowledging the possibility of Congress not being able to approve a new stimulus package for some time. And that means the economy might be reliant on people who have been increasing their savings over the past year. And to tell you the truth, if that is the case, it makes me very worried about the wealth gap just growing even more, because as we know, it is the least wealthy families that have struggled the most, and they're the ones that don't have savings. This is going to hit them the hardest again, but that's for another video, as I could talk about that for hours. Let's just talk about the stock market. And when we look at the stock market, you pretty much, I would say, have 2 sides to the equation. So arguing why a crash is coming are the points that the stock market, I mean, it just shouldn't be anywhere near its all-time highs when the economy is suffering so much and there is so much uncertainty. It also looks like the market, it appears to be pricing in the idea that the economy will be returning to normal in 2021 and then continue growing. But what happens if it takes longer than expected? Will that cause a setback for the stock market? Now, arguing in favour of the stock market is that if the economy does recover, we could actually see a release of pent-up demand which kickstarts the economic growth. After all, this economic crash is really like no other in history. And if the Fed does continue to act as rapidly and as powerfully as they have done so far, the market might even continue climbing in tough times, but it will perform especially well if a quick economic recovery does happen. Now, like I said at the beginning of this video, I want to tell you both sides of the argument so that you can form a well-rounded opinion and you can make your own mind up. I want to give you both perspectives so that you can make your own decisions, and I hope that I've done a good job of doing that. But what I'm going to add is that study after study consistently has shown that trying to time the market is a bad idea. If you are sat in cash other than an emergency fund, that's usually the last thing that you want to do. At the same time though, if you are concerned about the stock market, I get it. I completely feel the same way. I really do get it. That's why I'm always talking about diversifying. So not just buying stocks, but buying a little bit of other investments like gold too. So for me, if I'm bullish on stocks, I might invest heavily in the stock market. If I'm a bit more concerned, then I tend to diversify into other investments to hedge my bets. Either way, I just hope that you're safe with everything that's going on, and I hope you take the time to look at both sides of the coin. I mean, I know from personal experience, I've tried to make predictions here on this channel, and I'll hold my hands up and say I've been totally and completely wrong. So I just think it's always a good idea to have a look at what the other side of the argument thinks too, even if you don't necessarily agree with it. Every Tuesday and Friday, I release videos like this. So if you've enjoyed this, remember to hit the like button so more people will see it, and hit the subscribe button so you don't miss the next update. And of course, just thank you for watching.